This is Dean with Defending Your Finances. Thank you for stopping by our channel and taking the time to check out this video. If you find our videos helpful and informative, please subscribe to our channel by clicking the subscription link below and share the videos with your friends and family on social media. Also, shoot me an email at the email address in the video description and let me know what information you would like covered in our upcoming videos. Thank you so much for supporting our channel and liking and sharing our videos. It means the world to us. May God bless you and your family. I want to ask you a question. How many times have you heard the following statement? Don't invest in bonds, they're a bad investment. Or, you're crazy to invest in bonds right now. The bond market is going to crash. But how many of us ask the simple follow-up question to these statements? Why? Why are bonds a bad investment? Why is the bond market going to crash? Is the bond market going to crash? Are bonds a bad investment right now? This goes to show how little people truly understand about how bonds work. And in this video, I want to explain in the simplest possible terms exactly how bonds work, making you more educated and informed on this very topic, arming you with the information necessary to decide whether or not the previous statements hold any merit. I'll also explain the difference between investing in individual bonds versus a bond mutual fund. So let's start with the simple definition of an individual bond. When a company, a country, a county, or anyone else issues bonds as an investment, they're classifying themselves as a borrower, and they're asking for people to lend them money based on certain conditions. The borrower, or the company issuing the bond, specifies how much money they're going to raise or borrow, like 100 million or 500 million and so on, and will go out into the open market and ask investors to lend them the money. These loans have two major components. Number one, the interest rate that the loan will pay the lender, and number two, how long the company has to repay the lender, like 5 years, 10 years, 30 years, and so on. And from the day you buy the bond or lend the money to the company until the end of the loan period, otherwise known as the bond's duration, the company will pay a certain amount of interest every so often during the years you own the bond, like quarterly, semi-annually, or some even annually. At the end of the bond's duration, the company will then repay you the original loan amount or the original amount you invested. Now, I mentioned two of the major components, but there are a couple other minor components that are worthy of mentioning. These are, number one, whether or not the bond is callable or eligible to be paid off early at a certain period of time. And number two, whether or not the bond is convertible to the company's stock at specific predetermined amounts. So let me just do a quick knowledge check. When you buy an individual bond, you're lending money to a company for a specific amount of time at a predetermined interest rate. During the time you own the debt, the company will pay you interest every so often, and at the end of the bond's duration, the company will then return your original investment amount in totality. Now, if the loan conditions are no longer advantageous to the borrowing company, the bond may be callable or may allow the bond issuer to repay the bond early, similar to how someone can refinance their home loan when their interest rates drop, and end the agreement early. And some bonds are convertible. They can be converted into the stock of the company at a predetermined amount. Lastly, the amounts that you can invest are usually in pretty low amounts, ranging anywhere from $100 per bond to $10,000 per bond, making it pretty easy for most investors to invest in these bonds. It doesn't sound too bad, right? It's not. Individual bonds are actually a pretty good deal. They're predictable, they pay a steady income during the life of the bond, and they allow you to receive your original investment back at a specific point in time in the future. Repayment and interest payments are not dependent on the profits, quarterly performance, or growth of the company's stock price. They are contractual, and just like any other loan, you can count on these factors. It's usually around this time that people ask me, Dean, what's the downside of buying an individual bond? And I'm getting to that. There is a downside. Just like when any lender will evaluate a borrower, it's important to know the credit rating for the company borrowing the money. Typically, the higher the credit quality, the lower the risk of the company is going to be on defaulting on its obligations. Therefore, investing in a company with a higher credit rating will likely have a lower interest coupon, and investing in a company with a lower credit rating will have a higher interest coupon. It's kind of that risk and return trade-off that we all hear about. Also, just like any investment in a single company, you lack diversification, otherwise known as having all of your eggs in one basket. Your investment is at risk if the company were to go bankrupt. If this were to happen, remember that you're considered to be a lender to the company. You're going to be first in line to be repaid when the company's assets are liquidated. Also, if you wanted your money back before the loan is supposed to be paid back or prior to the bond's maturity, you can't just go to the company and ask them to repay the principal early. Remember, a bond is a contractual agreement between a lender and the company or the borrower. You too are under contract to get your principal back after a specific time period. So if you want to get your money back early, you'll need to sell that bond to another willing buyer. If you were to do this, the amount of money you get back will depend on supply and demand. This is where you're at the mercy of the market. This is where interest rates come into play. So let's say you buy a bond for $1,000 and that bond has a 5% interest coupon. A few years after you buy the bond, interest rates were to go down. And the best interest rate you can find in the open market to invest new money into is, let's say, 3%. All things being equal, your 5% bond will be in greater demand and worth more money. So let's say it's worth now $1,100 instead of the original $1,000 you paid. You have a gain, $100 or a 10% gain. Now conversely, if a few years after you buy your 5% bond, the market interest rates go up and I can now invest new money at a new bond paying 7%. The demand of your 5% bond goes down and the value goes, let's say, to $900. This is why people are fearful of investing their money into bonds when interest rates are at all-time lows and poised to go higher like we're seeing today. But let me remind you, the increase or decrease of your bond's value only applies in the event that you need to sell the bond to someone else before the bond matures. If you hold the bond to the maturity date, regardless of what interest rates do, the company will always repay you your original investment amount. Now that you understand how individual bonds work, let's switch gears a little bit and talk a minute about bond mutual funds. Now, a bond mutual fund is when a company hires a specific manager to buy hundreds of individual bonds and manage the performance of these bonds to the benefit the investors collectively. The manager will buy and sell certain individual bonds primarily in an attempt to make money on the bond's increase in value, and for the interest income that the bonds will generate secondary. Slices of this bucket of individual bonds are sold to investors. An ongoing annual fee is charged by the investment company for print materials, to pay commissions, and to have the manager manage the fund. This usually ranges anywhere from 0.5% to 2% and could have an upfront one-time fee of as much as 5.75% or so. Now, this isn't just a one-time fee to open your account. This is per new dollar that comes in. So you need to make sure that any mutual fund you invest in doesn't have one of those 5.75% upfront fees for every new dollar you put in. That can make it really expensive. The problem is that the fund manager of a mutual fund is obligated to have a certain amount of the fund's money invested in bonds, usually about 75% of the fund's total assets, regardless of whether or not it's the right time to invest. Since these requirements exist, and many things are outside of your control, it may be difficult to know whether or not a specific bond mutual fund is best for your specific circumstances. Not only that, but these fees are charged by the mutual fund company. They may absorb most of the interest that the bonds pay. So be sure to understand exactly how the bond mutual fund is invested. You can easily look up the fund's ticker symbol and discover the average maturity for these bonds held in the fund, the average interest coupon, and the average credit quality. If the fund's characteristics match your investment needs, then it may be a good fit. It also may be best for you to invest in individual bonds based on your best interest that will meet your specific needs. Make sure you do your research and ask a lot of questions. And if you're working with someone who calls himself a financial or investment advisor, make sure they understand your specific needs before you agree to any particular investment strategy. If they don't know your tolerance for risk, your tax circumstances, or your time horizon, you shouldn't expect them to be capable of making a proper recommendation. I hope all this makes sense. If it doesn't and you have any questions, don't hesitate to reach out either by email or you can reach out to me on Facebook or Twitter and let me know any questions you might have or anything you want me to clarify. But for now, this is Dean with Defending Your Finances. Thank you for watching. Your support to this channel means everything to me. Stick with me and I'll make sure to show you the truth about the financial services industry and tell you all about the things that few people know and very few people in the industry talk about. Thank you so much and God bless you.